Olawale Olusi, investment analyst with AfriInvest, joins me now to give us his perspectives on the market. A good morning to you, Olawale.
Good morning, Harry.
Well, it's definitely a September to remember for investors and market watchers. But looking at how the markets fared last week, what are your thoughts?
Well, basically, the market was broadly driven by the CSA implementation that occurred on the 15th of September last week. And then we saw what happened across the market. Unlike how the market opened on Monday, there was panic across the market segment, with the money market being the most hit. We saw call rates rose above 100%, and of course, OBB and OVN rates were up to about 50% from about single digits in the previous day, due to the liquidity funds that hit the system, because banks, they have to remit a lot of cash in CBN, given the directive from the federal government. In the equities market, unlike 2.3% gain on Monday, we saw the market plump 4.2%. Of course, in the bond market and the CDS market, we saw how investors reacted. But the interesting thing about what happened last week was the way the market actually moderated panic in the subsequent session. We saw the equities market rising 0.2%, covering the losses from the previous day, and of course gaining at the same rate on Thursday. But on Friday, we saw that the market actually declined 4.2% again. But on a week-on-week basis, equities market was up 2.3%, broadly driven by the gains from Monday. Of course, in the money market as well, we also saw rates moderating significantly as against what we saw on Tuesday after the implementation of the CSA. And like you said earlier, we also saw bond yields moderating slightly by about 10 basis points during the week. Other developments during the week include the bond auction that happened on Wednesday against the prediction of liquidity that will leave the system. It is surprising to note that the market is still sort of awash with liquidity, because each of the bond auction was oversubscribed, though the DMO didn't have to allot everything that was offered. We think that is probably due to the rate that investors are quoting, basically. So that was what we saw last week. For this week, we think the MPC decision is likely to be the big issue to watch as against the CSA last week.
Well, definitely. So let's talk a little bit more about that. We've got about 60 seconds or so to talk about it. The Monetary Policy Committee meeting begins today. It's a two-day meeting, and investors' eyes are going to be on it. What do you expect, or how do you expect the markets to react? Do you expect to see positive momentum, whether at the equity segment or the fixed income segment of the market, or you expect to see negative trading?
Well, I think, of course, the market, all eye will be on the MPC, like you said, and the market is broadly interested in what the MPC will be doing about CRR, because already the CBN governor have already ruled out the devaluation of the currency, despite the threat from JP Morgan to phase out Nigeria from its bond index. And then we do not really expect any change in terms of the monetary policy rate, that is MPR. But because of the TSA implementation last week, we expect a slight reduction in the current harmonized CRR of 31%. So if that is done, we think it might boost investment confidence in the system, because banks will be, they will have enough liquidity to give out loans and of course create more risk assets. But I think broadly looking at how the market will react, we don't really expect a significant reaction, because the forward guidance given by the CBN so far has kind of suggested that if there's anything that will change in this MPC meeting, it's likely going to be CRR, just to allow banks have some ability to create risk assets.
Olawale Olusi, thank you so much for your perspectives this morning.
Thank you very much, Harry, for having me.